Financial. This is the only place you need to be to forge a stronger portfolio. Because we don't just report the news, we stress test the market's biggest names. I'm your lead analyst. Today, we're putting Bank of America on the anvil. They just released their full year and fourth quarter 2025 numbers, and we are going to hammer through every line item to see if this thing is truly built to last. So, let's get right to it. This is the big question on the table today. Bank of America is telling the world they pulled in over $30 billion in profit for the year. And look, on the surface, those numbers, they look like solid steel. But our job here, you know it, it's not to just stand back and admire the polish. Our job is to stress test the entire structure, from the foundation all the way to the top floor.
That's exactly right. Look, anybody can read a headline on a press release. We're here to cut through the executive sweet talk and all the market noise. We're going to find out if this financial giant is really the fortress of stability it claims to be, or if it's just a well-polished facade that's going to crumble at the first real economic tremor. So come on, analyst. Is this $30 billion skyscraper built on bedrock, or is it built on sand? Let's get to work.
You got it. So first things first, let's set the stage, because understanding Bank of America isn't just about analyzing one single company. You have to think of this thing as a bellwether. Its performance is a direct reflection, a mirror of the American consumer and the health of the entire U.S. economy. I mean, its loan book, its deposit base, its trading activity, it's like a macroeconomic report all by itself. Their credit card data, that tells us exactly how people are spending. Their small business loans, that tells us about entrepreneurial confidence. That's why these numbers matter to every single one of us, not just people who own the stock. When we analyze these numbers, we're literally taking the temperature of the nation's financial health. All right, let's get into the rapid-fire round, the heavy metal. First up, you see it right there, the headline number, $30.5 billion in full-year net income. That is a massive, massive figure. But what's more important is what's behind it. That's a 13% increase year over year in an economic environment with all sorts of crosswinds and uncertainty. Posting double-digit profit growth at this kind of scale, well, that's a serious display of raw power. This isn't just a number on a page, it's a statement of dominance. Next, let's translate that mountain of profit into what it means for shareholders. The full-year earnings per share, or EPS, came in at $3.81. That is a 19% jump from 2024. Now, this is the heavy lifting that investors live to see. It shows that the profit growth isn't just because they're huge. It shows they're getting more efficient, more potent on a per-share basis. That is how you build real long-term strength in a stock. And here is the engine that is driving this whole machine. Full-year revenue hit $113.1 billion. A 7% increase year over year. You have to understand, to grow your top line by 7% on a base this enormous is like trying to turn an aircraft carrier on a dime. It shows they have serious momentum across all their vast operations, from the little local branch on the corner to the massive global trading desks. The sheer scale of what we're looking at here is just hard to overstate. Okay, hold on a second. Pump the brakes. The numbers are big, I'll give you that. No one's denying that. But is this just because it was a decent year for the market, or is this a sign of real, durable, long-lasting strength? I mean, let's be honest. We hear this kind of C-suite optimism all the time, right?
And that's a fair challenge. It's the right question to ask, and it brings us directly to what the man in charge, CEO Brian Moynihan, had to say about it. He's not just sitting there saying, hey, we feel good about our performance. No, he's making a definitive statement. He's saying we are bullish on the U.S. economy in 2026. Now, coming from the head of a bank that has this much granular insight into consumer and business activity, that's not just a quote in a press release. That's a forward-looking indicator based on the billions of data points he sees every single day. He's betting that the underlying economic structure is sound.
So, with that bullish outlook setting the tone, it's time to pop the hood. A $113 billion revenue figure looks fantastic, but it's totally meaningless if we don't understand the components. We need to get in there and analyze this revenue engine, piece by piece, to see where the real power is being forged and, just as importantly, if any of the parts are starting to show some wear and tear. Let's drill down into the fourth quarter specifically, because that really tells the story of their momentum heading into the new year. Total revenue up a very healthy 7% to $28.4 billion. But here's the key. Look down a couple of lines at pre-tax income. That jumped 17%. What that tells you is they have powerful operating leverage. Their profits are growing way faster than their sales. That's the definition of efficiency.
Okay, I see that, but my eyes are drawn to that line in the middle. Non-interest expenses up 4%. That's still an extra $700 million in costs they didn't have last year. So while revenue is definitely outpacing it, we can't just ignore rising expenses. Where's that money going? That's a potential drag on the engine you're talking about.
That's a valid point on expenses, and we are going to come back to it. But first, let's focus on the absolute core of any bank's engine, net interest income, NII. This is the fundamental, old-school business of banking. It's the spread between what they earn on loans and what they have to pay out on deposits. In the fourth quarter, NII hit $15.8 billion. That's a $1.4 billion increase from the same quarter last year, a full 10% year-over-year growth. This is a direct illustration of this model's raw power in the current rate environment. They are cashing in on higher loan balances and the repricing of their assets. This right here is the bedrock of their earnings power. Okay, so the core lending business, the bread and butter, it's strong. I get it. But what about everything else? I mean, a modern financial giant like this can't just live and die by interest rates. What other pistons are firing in this engine? Are they actually diversified? Or is this whole story just one big bet on what the Fed does next? Great question. So let's move to the other side of the revenue coin, non-interest income. And what you see here is a tale of two different but very powerful drivers. On the left, you've got the absolute powerhouse, sales and trading, up 11% for the full year. They hit record revenue in equities trading and have now posted 15 straight quarters of year-over-year growth. You have to understand, that's not a lucky streak. That's a high-performance machine that's been firing on all cylinders for nearly 4 years straight. It's their all-weather engine. Then on the right, you have investment banking, which saw a more modest but still important 7% rebound. After a really tough couple of years for deal-making, they're seeing a solid recovery in advisory and capital issuance, and they secured a number 3 ranking in IB fees. So to answer your question, yes, they are diversified. They have the consistent trading engine and the recovering deal-making arm working together. All right, we've inspected the engine, it's powerful, and it's diversified. But you know, a powerful engine in a weak chassis is just a recipe for disaster. So now it's time to move from the engine to the chassis. We're leaving the income statement behind, and we are getting into the balance sheet. This is the bedrock. This is the foundation of the entire institution. This is where we gauge true long-term stability. And the foundation of any bank starts right here. $2 trillion in total deposits. Just let that number sink in for a second. That's up 3% year over year. In a year where we saw a lot of anxiety and concerns about deposit flight at other banks, Bank of America not only held its ground, it grew its base. This massive, sticky deposit base provides them with immense stability and, critically, low-cost funding for all their operations. This is the raw material for their entire business. And this is what they're doing with all that raw material. They ended the year with $1.2 trillion in total loans on the books. That's an 8% increase from last year. So the crucial point here is that they aren't just sitting on that mountain of cash from deposits. They are actively, and you could say aggressively, deploying that capital into the economy, lending to consumers and businesses, which in turn is what fuels that massive net interest income we just talked about. This is the sign of a healthy, functioning financial machine. You know, an 8% growth in loans, you call it healthy, but I could call it aggressive. With all this talk of economic headwinds and a potential slowdown, are they getting over-leveraged? Are they stretching that foundation just a little too thin? How do we really know they can handle a major shock if the economy turns south?
That is the single most important question you can ask about any bank. And the answer lies in one single critical number, the Common Equity Tier 1 ratio, or CET1, which stands at a very strong 11.4%. For those of you who don't live and breathe this stuff, CET1 is the key measure of a bank's ability to absorb unexpected losses. It's their core capital buffer. Now, to put that in perspective, regulatory minimums are way down, closer to 7%. So at 11.4%, they aren't just meeting the requirement, they've built a massive safety margin into the structure. This is the shock absorber that protects the entire institution from a sudden market collapse. The fortress is well fortified.
Okay, fine. The capital buffer is thick. The walls are high. I get it. But a fortress is only ever as strong as its weakest wall. That massive $1.2 trillion loan book is only an asset if people are actually paying the money back. So let's stop admiring the thickness of the walls for a minute and start looking for cracks in the armor. Let's stress test their credit quality. This is where the real risk lives. An excellent point. And you know what? The data might surprise you. This chart shows the trend in total net charge-offs. These are the loans the bank has officially given up on and written off as a loss. In the fourth quarter, that number was $1.3 billion. Now that sounds like a lot of money, but you have to compare it to the same quarter last year, when it was $1.5 billion. The trend is actually heading down, not up. From a 30,000-foot view, their overall credit quality is getting stronger, not weaker. Whoa, 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 hold on a second. Not so fast. The devil is always in the details. The total number might be down, but let's break that down. Look at that second bullet point, consumer net charge-offs. The money owed by everyday people on their credit cards and loans, that actually increased from the third quarter. Yeah, it's a small increase, just $14 million, but it's an increase nonetheless. Is this it? Is this the first hairline crack appearing in the foundation? Is this a warning sign that the American household, the very bedrock of their biggest division, is starting to feel the strain? This is the number I'm watching right here. You're absolutely right to flag that. The health of the consumer is critical to this whole story. And that uptick, however small it is, absolutely bears watching. And to really understand that risk and how it fits into the bigger picture, we have to deconstruct the entire business. We need to look at its diversified structure, which is built on 4 very distinct pillars. This is how we'll see if a potential weakness in one area is being balanced out by strength in the others. And here's how those 4 pillars stack up. In the fourth quarter, you can see that consumer banking is the absolute behemoth. It's driving 44% of the company's net income. That's the engine we're watching so closely. Next up is global banking, which serves their largest corporate clients, coming in at 28%. Then you have the steady, fee-driven business of global wealth and investment management, which brings in another 19%. And finally, the more volatile but recently high-performing global markets arm contributed the final 13%. This mix, this diversification, is their primary shield against weakness in any one single area. Now let's break them down one by one. First, the biggest pillar, consumer banking. The scale here is just immense. I mean, they added nearly 700,000 net new checking accounts and opened almost 4 million new credit cards in 2025 alone. Their deposit base just in this one segment is over $1 trillion. This is a powerful engine for organic growth.
It's an engine, all right, but it's also the source of that little uptick in consumer charge-offs we just highlighted. 4 million new credit cards sounds great for growth, but it's also 4 million new points of potential risk, especially if the economy starts to soften. So you have to see this pillar for what it is. It's both their greatest strength and their most significant exposure to the financial health of the everyday American.
That's absolutely true, which is why this second pillar, Global Wealth and Investment Management, or GWIM, is so important for balance. This is a totally different kind of business. It's less about the volume of transactions and more about high-margin fee-based revenue. You can see client balances swelled to $4.8 trillion, up 12%, mostly thanks to strong market performance. And they're still bringing in new money, adding 21,000 net new high-value relationships. This division is a consistent, reliable pillar of strength that's much less sensitive to credit cycles and more tied to the performance of asset markets. It's the stabilizer. Now let's bundle their 2 global powerhouses together. First, global banking, which advises the world's biggest companies on their biggest deals. After a really slow period for the whole industry, they've roared back, claiming the number 3 spot in investment banking fees globally. That is a strong signal that the M&A market is coming back to life. But the real star of the show has been global markets. As we mentioned, they posted record equities revenue. And that final point on the screen is the one to really focus on. 15 straight quarters of year-over-year revenue growth in sales and trading. That is an absolutely dominant multi-year run.
15 quarters is one hell of a run, I'll give them that. But nothing, and I mean nothing, lasts forever. Trading revenue is notoriously volatile. Hitting a record performance just sets an incredibly high bar to clear for next year. So the real question is this sustainable, or are they just riding a market wave that's about to crash back to shore?
And that, right there, is the billion-dollar question. Sustainability is everything. So we've done the work. We've stress-tested the engine, we've examined the foundation, we've looked for the cracks, and we've deconstructed the pillars. Now it's time to weigh all the evidence. It's time to hammer out the final verdict. Is Bank of America an opportunity to forge a stronger portfolio, or is it a trap waiting to be sprung? Let's lay it all out on the table. On the left side, you have the pillars of strength, and they are significant. A powerful and truly diversified revenue engine that combines that steady net interest income with powerhouse trading and recovering investment banking. A fortress balance sheet, plain and simple, with that massive deposit base and a capital ratio that's built to withstand a serious storm. And the results speak for themselves: strong shareholder returns and consistent organic growth in their core franchises.
But you absolutely cannot ignore the other side of the ledger. These are the potential stress points, and they're real. That small but significant rise in consumer charge-offs, that's a red flag. The persistent creep up in non-interest expenses could eat into their margins over time. The heavy reliance on that record-setting, market-sensitive trading revenue is a real question mark for next year. And of course, looming over all of it are the broader economic headwinds that could impact every single one of their businesses. You can't analyze a bank in a vacuum.
So, after all of that, here is the iron verdict. The stress points are real. They must be monitored. The health of the consumer is absolutely paramount, and expense discipline is crucial going forward. However, when you weigh all the evidence, the conclusion is clear. Bank of America's immense scale, its profound diversification across 4 powerful pillars, and the sheer strength of its capital and liquidity foundation make it a durable heavyweight. This isn't a company that's built for a bull market sprint. This is a heavyweight that is built for the grind. It's constructed to absorb economic pressure and continue to generate massive profits. The cracks the skeptic rightly points to are worth watching, but from where we stand, those are just hairline fractures in a foundation of solid iron. The structure is sound. And that's our teardown. To keep forging your portfolio's strength with analyses just like this, make sure you subscribe to Iron Financial. We'll see you next time.
I am not a financial advisor. This is for educational and entertainment purposes. Do your own research.